Good morning, bright and early. It is great to be back at the Hunter Conference in new surroundings and pretty incredible surroundings. So thank you to Christian for hosting us here at the Hilton.
Thank you all for being here.
Great conference, always getting better, and so thank you to the Hunter team. I will do introductions, though this panel probably doesn't need them. To my left here is Christian Charneau, who is the Chief Development Officer at Hilton. We have Karim Alibai, who's the founder and principal at GenCom. Mitch Shah, founder and CEO at Noble Investment Group. And on the end there, we have Scott Trebilco, Senior Managing Director at Blackstone. So let's get right into it. So hospitality transactions, 2025 certainly wasn't a banner year. And it seems that there was a deep slumber before that, but it actually seems like things are getting done. And thankfully, on our panel, we have people who are doing a lot. Scott, we'll start with you. I know Blackstone, you were here 2 years ago and said it had been a few years since Blackstone had bought a hotel. And now it seems that maybe by Blackstone standards, you're not buying a ton, but you seem to be active in almost every process. What's changed? What are you looking at? And give us a little overview.
Yeah, well, thanks for having us here. Really nice to be back again this year. I think it was 2 years ago, we were sitting on the stage and we hadn't done a hotel deal in the prior 12 months. And this time last year, sitting on the stage, we'd just been starting to leg into it. We'd done 3 deals, and I think there was a lot of optimism going into 25 that it was going to continue to escalate and accelerate. And then, of course, the events of April happened, and that created a lot of market uncertainty for the subsequent few months. And the markets really froze. And when you sort of think about what happened in the back half of the year, we had a reacceleration sort of post-Labor Day, and volumes ended up overall in the market up year on year, something in the mid-teens, and we were no different. We ended up doing 4 deals over that time period, and I think we were sort of from a volume standpoint, we were up about 50% year on year. I think when you look at what was going on in the market last year, a lot of uncertainty, operating fundamentals still pretty muted, and a lot of dispersion across markets and across asset classes. And so I think our strategy was certainly not a broad macro hospitality bet that we're all in. It was a very calculated, targeted strategy focused on certain markets, focused on assets with certain characteristics that we thought were better set up to outperform and create growth over the near term, things where we felt like there was a clear asset management strategy. I mean, we're very focused in, last year it was New York, it was Miami, it was San Francisco, and then it was coastal Florida. And I'd say the theme amongst all of those is sort of higher ended segments, markets where we think there's multiple dynamic demand drivers, and really targeting kind of group and leisure as a heavy theme in and around that as well. I think if you look at the current moment, a good barometer, I think, of our transaction appetite is how much I'm on a plane. And I think I've been on a plane 90% of the days so far this year, much to my kids' disappointment. And it feels like our pipeline right now is as big as interesting as it's been. So it feels like we're setting up this year to continue the acceleration that we've started on the last couple of years.
Mitt, I know, I think Noble bought over 100 hotels, is that right, last year?
Right.
Can you tell us maybe what you're seeing that maybe others are not?
Yeah, we're seeing Blackstone not buying hotels. So they're not going to buy themselves. And I think what's interesting about my buddy Scott here is that I think your own personal conviction that on this sector, if you took off the Blackstone hat for a moment, right, and walking in and having to compete with data centers and logistics and other things, it might be a little bit of a different narrative and a little different story. I think the story that's actually accurate is this is not like, hey, let's just load up the truck and go buy everything that's out there. It is not just markets, but it's actually the street corners and the neighborhoods in those markets. It's very different. I think if I look back to all the cycles in the past, and dating back, we were talking about this last night. We've known each other since '94. And there's a lot that's happened. But if you just go back to the GFC, like our best investment years were 2014 and 2015. So if you just think about the time that it takes for things to kind of go through the system, And what was transpiring last year, just to your question, Cyril, is that the need for CapEx spending, not because Christian and and his other brand colleagues were just forcing it down that like, hey, these owners have to do it. Like you just couldn't compete in a market, without that capital spending taking place. And we all know that this industry wasn't fully renovated, before the global pandemic. So the combination of that, and then also some generational planning that needs to take place. As we all kind of get older, these partnerships they don't just all last the test of time. And so the combination of new capital needing to come in and the like created an interesting dynamic. And we actually found ourselves, as kind of, from an investment standpoint, without our friends like Blackstone and others, leaning into the marketplace.
Right.
Because, by the way, they could write a $5 billion equity check on a data center and call it a day with some pretty good, healthy economics, right? Which others could not do. So I think that was something that we felt like was the migration of opportunities. And everyone likes to ask the question: are the individual transactions or the portfolios? We saw a lot of portfolios last year, and that's really where I think in times past we would have felt more competition in that. But given the noise of last year, and I think the long-term perspective that we have, it became an opportunistic time for us.
I think on your point, Mitt, I mean, one of the things I've observed is if you look at transaction volume the last year in particular, and probably the last couple of years, and you bifurcate it between generalist real estate investment funds and hospitality dedicated, there's definitely been a shift of weighting towards hospitality dedicated because their job is to invest in hospitality through cycles, and our job is to invest in the best possible investment return deals we can across the real estate landscape. And so we're constantly sitting there, as you mentioned, evaluating risk return across different asset classes, and it just happens to be the case that we're extremely bullish on digital infrastructure right now, and we can deploy capital and scale, and we have the best platform in the world, and so we're leveraging into that, and we compare the risk return of a cyclical asset class like hospitality, where we're going through a period right now of mediocre fundamentals. It's harder to rationalize that in this very moment.
Karim? Seemed like every luxury transaction in 2025 had GenCom's name all over it, so congratulations on a very successful year. Can you tell us a little bit about what you guys are seeing in the luxury side?
Yeah, so a few things coming out of the pandemic. I think there was an adjustment period where sellers and buyers just were not completely in sync. And while the resort sector really flew very high, we know the urban and the city, both luxury and upper upscale, were really trending behind business travel, conferences, various things. And so while we have been quite weighted resort heavy in our portfolio, what we started seeing in this last 24 months is certainly a loosening up of where sellers were becoming more realistic, especially institutional sellers, on pricing and value. And that gave us, by way of example, in New Orleans, which is a market that had quite a bit of headwinds for some time. We acquired the Ritz and the Marriott there in New Orleans, and that's really, really performed very well for us. New York City has been another market where everyone has been quite a bit of fear of the CBA contract and renewal. At the same time, we saw a very rare void in New York City that at one point you couldn't afford to touch anything on the luxury or upper upscale side because you would have from Asia, from Middle East, from buyers all over who would pay 3-4 cap rate deals. All of a sudden we found that, again, thanks to Blackstone waking up now on some fronts, that the market was actually a little bit open for us to come in and transact, and we bought 3 large hotels in New York City. So we're feeling very good about where the balance right now is, while the operating fundamentals still have, especially in urban markets, a ways to go. Labor costs are definitely not easy to deal with. And I think it was last night we were chatting that the New York Hilton was it 2004 had 100 million of EBITDA, and
Meaningfully less now.
meaningfully less. So I'm the numbers exactly, but we're having those challenges. But pricing and value are not adjusting to this reality. We're starting to see that, which gives us a good shot to go in. And given the nature of our capital, which is primarily partnerships with family offices, while we still do some institutional partnerships, realize we don't have the pressure of this 3 and 5 year IRR and holds, so we can actually go ahead and underwrite to a 7 to 10 year hold and see it through, which gives us somewhat of an edge over others in the market.
Christian, take us through Hilton. We have obviously have select service buyers. We have luxury buyers on the panel, and you kind of oversee it all. Where is Hilton seeing growth, and what are you seeing in the transaction volume that as we look into 2026?
I mean, I would say taking a step back. First of all, good morning, everyone. Welcome to the Hilton Signia. We're very excited that you're here. I would say, look, if I sat here on stage last year and listed everything that was going to happen between March of last year and March of this year, and what we as an industry, and I wouldn't say it's been easy, but what has been absorbed, right? The shock absorbers, and obviously top line, we'd love it to see stronger. Cost pressures are still there, but the resiliency continues to, I think, show through. And then you combine that, and I think it's been said here in a variety of ways, there seems to be momentum building, and I would say across sectors. I wouldn't say just in luxury or select service, but that's building, and the question is why. And I think if you think about, and these are many things that we have talked about, we've got certainty of tax policy, you've got inflation is cooling, interest rates, we've got, I think, someone in the Fed and a real dedication to bring those down, and I think that will naturally occur. And you've got AI infrastructure and other kinds of investments that are going on, including government investments in the Green New Deal and other things, CHIPS Act, that haven't all come through the system. Historically, non-residential fixed investment has been the biggest correlator to room night demand. Everything would indicate it's usually on a lag. Poorly forecasted, but it seems to be accelerating this year and into next. So you think about, okay, it's a resilient industry, the shock absorbers are there. There is definitely some tailwinds emerging. We think particularly in the back half of the year. That sets up for, if you are set up to transact, your entry point could be very favorable. And across the U.S., across categories, we're seeing that momentum pick up.
That sounds fairly optimistic, which is obviously great for all of us. But I think if you look at, on the other side of that, if you look at STR and kind of what people are projecting for the industry, maybe other than luxury, you're seeing anemic RevPAR growth. I think they're forecasting 1.5% RevPAR growth in 2026 off the back of a 25 that was significantly below expectations. So it's great to hear the optimism, and you guys obviously have a lot of data that would back that up. I'm curious to the group, do you see these tailwinds? Are you optimistic about RevPAR growth in 2026?
So I would say that we're optimistic about RevPAR growth in 2026. And for a lot of the reasons that Christian just said, if you actually look at the data of what's coming through, and we've all talked about all the one-time events that are happening, World Cup and the like. But I think the more important part that we are always grounded. You talk about just why have we really leaned in from an investment standpoint. As much as we've had over the time period. It's still an 8-cap business, and cash flow is important. I think we realize that wherever interest rates go, it will normalize to where it has been historically, as opposed to what we've kind of had over the last 10 years. And quite honestly, our friends at the large capital allocators, they've been able to, kind of look at this space and say, hey, we can buy it roughly an 8, and we can finance it, back in the day at a 3. We can mark up values across the time, and then we can sell it in 5 years, and there's a great IRR trade. Well, today it is, and I think for us as specialists, has always been an operating business. So now if you think about the near term, while murky, this time last year we had 7% same store growth in January. Then Doge took place. We started seeing a flattening of trend lines. And I don't think anybody would have expected some of the noise aspect, Liberation Day, the largest government shutdown, in history. But even with all of that, as Christian said, like the year basically was flat, right? And again, for many of us who have been around a lot, you just kind of factor noise into the underwriting. And so whether it's geopolitical or whether it's, other things that take place, it's just, you look at it, over a period of time. So here's what I think we're optimistic about and what Christian said. The reality that, that travel is innate within us, the reality that there's more spend in terms of discretionary dollars, the K-shaped economy, and Christian, I'd love for you to just chat a little bit about what you're seeing here, is starting to converge a little bit in terms of that spending, which is normalized. Every time there's a shock, people make these absolute things like, there's a global pandemic, no one will ever sit in a room like this ever again. Like we do these things, but here we are, and this is what's happening. So I think that, and this AI revolution, which I think is an industrial revolution, it's our industrial revolution, will create not only more efficiency, and stronger GDP, but more mobility. And when you give people the ability to be mobile, they travel. And then when you pass down $90 trillion of wealth intergenerationally to people that didn't earn it, they're going to go spend it. This is just human behavior, right? And so, when I think about just kind of all of these things building against the lowest amount of supply growth that we've seen in our industry, the long-term demand equation, along with that, leads to kind of the optimism to say, hey, let's lean in. And again, oh, by the way, not to keep referring back to my buddy Scott here, is when you're an IRR-driven investor and you can invest as a leader in other asset classes, you want things to be a lot clearer before you start leaning into a sector, right? And we're not making predictions yet, but I would predict, based on all of this, a year from now, as we're sitting here, we're going to see a lot more activity on this side of the stage.
Yeah, and I can comment on the K-shape. And it was interesting, Delta actually took up their revenue guidance today, not just based on turning left on the plane, but turning right as well, right? So there's a lot of data to, it's starting to come in. We talked about it on our earnings call to suggest that the K and the recovery will collapse. Middle class growth will continue, and that, of course, bodes well for us. The other data point I would throw out there, we're talking a lot about deals, but as we saw last year in the U.S., we actually saw construction activity for new builds up 25%, and we think that's going to continue that momentum into this year. We're now approaching 2019 levels of construction, which again, muted supply growth, but I think that's another kind of green shoot out there to indicate that capital's flowing and folks are investing at an increasing pace in the business.
Karim, so we're talking about green shoots in the economy. It seems like your bets were more targeted on specific markets and or specific asset types. Do you think that will continue for GenCom, or do you think maybe it'll be, you could get a little broader in view?
Yeah, no, obviously, first and foremost, we're sort of opportunistic, value add are typically the formula. We try to keep new development construction to 20-25% of portfolio. Just as we all know, the trials and tribulations, especially of larger full service type, and given the labor markets. So what is interesting is we're taking a very active look right now at the whole West Coast. It's been beaten up so badly, and new supply obviously is at the lowest, in that part. As I again said earlier, we decided to make some, we were long Miami, New York. What we saw was unprecedented that, not only the demise of Airbnb, but the new supply and the costs and constraints, and even though, some of the risks, that the way New York has been performing, and this is, again, in light of one of the lowest periods of international travel.
Right.
This administration, what it's done, so we feel there's only upside once international travel really comes back. And you would think with today's AI, visas and immigration processing should be so much more easier, but none of those things have yet come down the pike. So yeah, again, while I would say targeted, but if the callers and said, look, in Houston or Dallas, there is a particular opportunity, and even the supply in those markets is heavy compared to others, we would absolutely go take a good look, because again, this is as much as a business as it is real estate. So you can find things, but I think we really are looking hard at this whole West Coast thing, because that's been beaten up just quite significantly.
Maybe we can take a slightly deeper dive into development, because we're talking about new supply being very limited, but there are places and pockets where development is happening across, from economy all the way to luxury. Christian, take us into the mind of some of your development partners. Are there any markets that you're seeing maybe more development in, maybe secondary markets, maybe Anaheim, or maybe Reno, or?
Yeah, maybe Reno. I mean, look, I hate to be anal, but I typically look at data to look at all this. And as we look at the data, it's a little bit everywhere. I would say it depends on where you are, if it's more luxury, more select service, but the common theme is it's all economically rational, right? And from our perspective, particularly on new builds, we're focused on driving the owner return, cash on cash return. So if you think of, we're out here at Hunter talking a lot about our extended stay brands. You've got Homewood, we've got nearly 600 of them. We're launching a new prototype, able to squeeze in 10 more rooms or suites, 3,400 less square feet, right? More ancillary revenue from F&B and other types of services. RevPAR index there, 125. Home 2, same type of thing. A little bit lower than Homewood, RPI 125. That was a brand that we launched 15 years ago. We got 900 of those, another 700 in the pipeline. So you're seeing traction there. And of course, LiveSmart, which is extended stay at a price point below that, just getting started, about 100 of those in various stages of construction or development. So extended stay continues to be a bright spot. Definitely got the labor arb. You've got dedicated long-term occupancy that you can yield. And it's a basis for dual brand, right? I think is another opportunity. About 80% of our dual brands, which is, you'll have a Hampton and a Home 2, for example, have an extended stay component, right? So it just gives owners more flexibility on yielding rate, more efficiency on labor and build costs, and you're seeing a lot of traction there. And then conversions. Again, we're talking about muted supply growth. About 40%, 50% of what we're doing in the U.S. is conversion activity from brands from LXR to luxury all the way down to our recently launched Outset. So when you go to market like that, like we try to, with a network effect that's going to drive RevPAR index and working, and I'm sure we'll talk about this, at the middle of the P&L to drive margin growth and ultimately cash on cash returns, for us, there are pockets here and there, but we're able to lean in with what makes sense and is economically rational.
I think one of the things that we've observed with new construction is over the last couple of years, we've obviously had moderate growth and we've had continued expansion of construction costs, because now you've got your short power in this country, and now we're short labor. And we're short labor in all of these people that are electricians, plumbers, all the people that are the nuts and bolts of development, because there's so much demand coming from the build out of digital and energy infrastructure across the country. It's driving up costs and the scarcity of resources for these people. So, give you an example, we've developed quite a few Great Wolf resorts over the past few years, and we have a project in Tennessee. We went and repriced it, and the costs went up 10% over the last 18 months. And it now costs almost $800,000 a key to build a Great Wolf resort in Tennessee. And I think what that's going to mean is, the spread to replacement cost if you own existing real estate continues to gap out. And so I think investing and owning existing assets and driving performance is going to be a really incredible opportunity for a lot of people in this room. And the barriers to new supply, I think, are going to continue to grow.
A bright spot when you talk about new development that we've found. We just opened our 4th resort in Costa Rica. is not only mixed use, but mixed use that comes back into the rental program. We're finding that to be in fact, in the last few projects where we've done this hotel and what they used to call condo hotel, but now, residences by XYZ, there was a point where people thought that anyone that paid for 1 or 2 million more than that for a residential unit would not want to rent it. Well, it's quite the opposite. People that are buying 10, 15, 20 million even residences, and in a number of our, for example, again, I'm talking about in Costa Rica, for example, with the Four Seasons and the Ritz Reserve and the Andaz, while the occupancy is 30%, but the ADR is $5,000 or $6,000. So we're finding actually the profitability yield from these units is more than actually even the residential profits on selling them. And now, both appraisers and even buyers are giving you the same cap rates. There was a time when, a Scott would come to a table, or it's in Key Biscayne, and say, well, I'm going to value 300 rooms at this, and I'm going to value 172 condo hotel units at this, because I have no assurance that they're going to be in the rental program next year or the after. That has become such a steady state of income that it's really helping defray the costs in new development in that particular sector.
It's really the only way to build luxury right now is to subsidize it through residential development, particularly here in the U.S. I mean, it's incredibly expensive to develop in any supply-constrained market.
Yeah, I'll make one comment just as it relates to the select service and extended stay space. It's how we started our business. We opened our first Hampton Inn in 1994. U.S. RevPAR was $40. Interestingly enough, it cost us $40,000 a key to go build it. And you cash flow day one, and it's a beautiful business, And reminiscing about times like that isn't healthy, because we obviously know, there's a lot that has changed in that time period. And the brands have come out seemingly with, more brands in which to offer to the table. Not just you, Christian, I mean, but, everyone. And not all brands are created equal. Just like not every part of this segment is created equal. And the cost equation, Home2 at the time that it was launched, actually hit the absolute right sweet spot. And to Chris's credit, he said that this is going to be a game changer, and it was. And I think, that was able to, land right behind Homewood. But it's such a different time to what Scott's point in terms of not only the cost escalation, but, where these, construction folks are now between the data centers and other areas and even, other parts of the real estate sector. But we always have a time period whereby, there's a lot going on with the workers and immigration and things like that create this lack of folks there. We're going to open up a Tempo in Savannah Historic District in a couple weeks. I'm not sure we could underwrite that at this moment in time today with all of those kind of cost increases. And quite honestly, we've built 20% of all of our investment activity a year. We haven't found a single new build opportunity that pencils in a 5-year hold period in the last couple of years.
What do you think? What do you think changes that? Just I'd love for others to
Well,
answer this.
look, I think it's a couple things. It's a continued work to make our business even more profitable. So if you think about the demand standpoint, all the things we talked about, the operating model, right? Which I know that the brands are really working in terms of how do you take costs out of the system? How do we actually leverage technology and then bring that back to the owners? We could spend a lot of time talking about that. Christian, you might want to say a word or two about that. But actually take a model and make it more profitable, such that any RevPAR increase isn't eaten up by cost increases. So that's kind of A. B is that construction, technology. We will also open our first next generation modular next month, which start of site work to opening, and that's a mid-scale extended stay hotel, which we call branded long-term accommodations, will be 9 months. So now you've shortened the time frame, obviously, and then improved the velocity of cash flows there. So there's some structural things that need to take place, but I think the reality is for so many that have made this incredible business, a part of our lives and ecosystem that have done it as developers. It's just going to be harder in which to use that as kind of the catalyst to grow platforms.
And I could jump in on that too. I mean, look, I took a sabbatical from the hotel business and the restaurant business for the past 7 years, working for Inspire Brands here in Atlanta. And we didn't have RevPAR index, right? There was no way of measuring your share of the market. And they look at the middle of the P&L of most restaurants, great business, but a lot more exposed to labor, commodities, and other things. So there's a mindset from that business on cash returns that we're very, very focused on at Hilton, and I think we need to be, because back when Home 2 was launched, it was all the RevPAR index show, right? That was the driver. And now if we look at the middle of the P&L, cost to build, the investment that goes in, what it takes to maintain a product of quality, a high quality and great service, clearly that's gone up. So it's leveraging our scale to look at what that margin is, what is the capital required to drive or get that margin, and making sure that margin is increasing over time. Because again, as we all are thinking about capital allocation, whether it's 5 years or a full 20-year length of a normal franchise agreement, the view's got to be, our scale's got to work for owners to drive not just top line, but everything that drives the margin. And we need to be smart, and there are programs we can talk about that we've done at Hilton, particularly on the fee side, where again, if you are meeting our standards and guest sat and other kinds of metrics, there's anywhere from a 75 to 100 basis point reduction that we're going to be able to do. That flows through nicely, and you combine that with no longer standard PIPs for everyone at 7 years or change of ownerships, but using all the data, AI, other things to make smart decisions on where capital really needs to be spent and allocated in order to maintain those high product and quality standards. We're looking at that and addressing it and thinking of it much more of that cash on cash return. Clearly still work to be done, but we have to be able to leverage that scale on behalf of owners and to continue the growth, because we're all aligned on that, right? Without that cash on cash return growth, our business model and your business model will not be fully optimized.
So Scott and Karim, you guys have been buying in New York City, which is obviously a very high labor cost growth market. So we will, you'll see in pressure on profitability. What are you guys doing from an asset management standpoint, or talk us through how you guys think you will manage that labor cost increase and what will help drive profitability in your portfolio?
You want to take it first?
Sure,
Go ahead.
sure. I mean, look, we are maniacally focused on the middle of the P&L, and really every aspect of it that is in our control. And remember, most of these hotels, particularly in like these urban cities, they're managed by other people and they're attached to brands, and so you have to work within those frameworks. And some of these are union work rules as well. So it's complicated. I think, businesses where we have full vertical control, like at Great Wolf Resorts, you can actually go and leverage a lot of different things, particularly technology and AI, and we're sort of on the front end of that. But it's manager models, it's your productivity for your housekeeping, it's your maintenance, and trying to figure out exactly how you do things more calculated and more thoughtfully. We're using AI for call centers now. There's a lot of things that we're on the front end of, even like invoice processing. You can now use technologies to try and optimize all these things. It's a collaborative effort. I think there's enormous opportunity for kind of enterprise transformation within the processes, and there's a lot of talented people out there right now that can come in and audit the process that you're doing, find any repeatable task, and find a way to augment that through some form of technology. And I think it's going to take time to sort of roll through the system, but I think when you wake up 12 months from now, we'll actually see it, and people will have actually adopted it, and then that will be when it becomes more broad-based and more widely utilized.
So when we decided to enter New York City, the first fundamental decision we had to make is, I think, to play in this sandbox, we need to do union hotels. Because for the kind of product we like to invest in, it's really mainly union hotels in New York City and not non-union. So once with that determination, then we said, okay, what are some of the positives that have come out of this? Well, clearly new supply, because just the cost to build with the labor costs are just not possible. So that was, and then as I mentioned earlier, the unions did put a movement together that got Airbnb off the table, which was, I think a lot of us would call it unfair competition. So with those two things in mind, as we got in, we said, okay, now profitability-wise, by way of example, this last asset that we just acquired, the Ritz in Central Park, the statistic was for this $23 glass of wine, it's costing us $68 by the time the guest drinks it. Whoa. Now, you can't not serve the glass of wine because otherwise you're inequality. So how do we take close to 10 million in F&B loss? And is there ways to, so some of the things we're working very hard is, again, working with the unions, is how can we do some quid pro quo trades where the F&B portion, you can let us either lease it out or have a different model, because that is just a killer. And just by way, another example is the Intercontinental in Times Square. We just switched from a normal breakfast and with the agreement of the unions to a buffet breakfast, $2 million a year savings. So that's an area that, obviously the price per pound has definitely adjusted in New York City very significantly compared to even 2015, 2016, 2017. So that's very attractive. And you say, if you're going to make a bet, you have to step in at some point. And yes, there is this new set of headwinds with the July contracts coming up, and the asks are very aggressive, but I feel that they'll get navigated through, but not for the faint of heart.
Yeah. So there's been, you guys have alluded to technology, and AI is obviously a topic on everyone's mind. Obviously, I think we all agree that we're at the very first part of it, as Scott said, and that maybe 12 months from now we'll see it. At this moment, is there one very concrete example of how AI is being used in any of your businesses right like today that you would be comfortable sharing? Anyone?
Yeah, I can give a couple of examples. I mean, we're putting a lot of resources against this, not just within sort of Blackstone Enterprise, but down through all of our portfolio companies. We had a first kind of collective call a couple of weeks ago at 150 portfolio companies around the world, sharing examples of what they're doing within their businesses so people can cross-pollinate, take those ideas, apply them to their own. We're doing the same thing within kind of our Blackstone Enterprise, and I'd say two examples. One's kind of like a work-related example, and the other is sort of like a bit of a fun work-related example. The first we do is, I was looking at a deal where it had a big condo development component to it. Very complicated. We had a lot of sort of different sort of market studies, 300-page JLL appraisals and things. We put everything in a platform that we have, which is proprietary to us, and dropped the data room in, and 3 minutes later it had given us a full development, sort of 7-year build-out, sell-out model that we could then go and spend the time doing real market diligence around the assumptions. And so it freed up a lot of capacity for the team that probably would have taken a week for a junior team to have built that out. It did that in like 3 minutes and gave them the time to then actually like focus on thoughtful inputs, speak to people in the market, just creates more leverage for the team. The other example, which I just was playing around with last week, was I had the team train this program to be the different personas of people on my investment committee. And I told them, as we're working on drafts of materials, put it in, ask it for what that person's going to ask, and then have it prepare responses in anticipation. And it was pretty incredible. I think people are a little concerned about what they think their persona really is now. But it was a really fun tool for the team to just start thinking about risk through different lenses. And I think it just teaches them at an earlier stage to what are the things you should be focused on when you're looking at a deal.
Yeah.
You know, it's interesting. I hope no one from Ernst & Young is here, but um, just recently we said, okay, we would like to get a residential study in Houston who's looking to do a mixed-use project there. And EY's, quote was $85,000 to do that. Well, you put it into the AI thing, it pretty much gave you 95% of what you needed to make the decision. So, I mean, there's a lot of those examples. Obviously, we all believe that with productivity, it'll create more. This has been the big debate, is this going to take jobs away, or are more people going to be able to, by way of example, they said, well, every 5 employees today you have, you'll be able to do it with 3.5 in 4 to 5 years. So then the immediate worry is that what happens to the other 1.5? Well, the other part is there'll be hotels built in Cuba and other places because, which is usually in the past industrial revolutions, all that have shown that the pie grows. So hopefully the other 1.5 are not displaced permanently, but they will have other positions to go to.
I think one of the greatest revelations I've seen so far is the team feels so much more empowered by the tools that we're now using. And it's eliminating very repeatable tasks that are just time intensive and not necessarily that rewarding for someone on the team. And I've just seen a level of excitement and enthusiasm now because they can reallocate their time into things that to them feel more meaningful and more impactful on the overall outcome of a process or a transaction. And I think that's what's going to be so incredible about this technology.
Yeah. I'll just make, I'm sorry, I'll just make one other comment. I think, our mantra is like, what takes 10 hours that will now transition in 10 minutes? And now what are you going to do with 9 hours and 50 minutes in terms of your own personal, like professionally, personally, like what does that time give you, And, I think for all of us, it's time's the most precious resource we have. We don't know how much of it we have, but in that time, in that frame, it opens up the possibilities, which is what the enthusiasm. The other thing that I would say is that, while there are proprietary systems and then there's, technology groups, et cetera, I think this is going to be available to everybody. Like you're going to be able to go in to Claude and say, hey, write me a code that, you can do this today, like write me a code that does this, and now all of a sudden you'll have like this program and this software that you would have had to go figure out what 4 vendors, that you want to hire, and you don't have to do that. But that's new. Like this has all happened in the last 3 to 6 months in terms of this next evolution. So if we now think this is what's happening, and I'm positive my team thinks like I'm totally, like nuts about this because I'm so frenetic. But like these best practices and these ideas and the people that are unbridled by the past, like I've done this for a long time, I know what I'm doing, like, I get the data and I get the information and it works and we've had a good track record and just look at it. Like how does confidence not become hubris, and how do you now take, things that are out there and be able to apply it differently? And I think these, innovation labs internally for all of us become like the most important part of our DNA as we think about going forward, because if it's changed this fast in the last 3 to 6 months, what does the next 3 to 6 months look like?
Yes. And the one thing I would add, Chris gave a very fulsome answer to this, and I know we don't have much time, so I won't go into all of it. But I would say high level, I think this is all net benefit for everyone in the room, because this business will continue to be one of people serving people. We're just going to give the tools at the operational level to do it more efficiently, effectively. And I think, you asked what is something that people can do today. On Hilton.com right now, you can go use the AI trip planner. It's a beta. We're still learning from it, but the whole booking journey can become more productive, interesting, and potentially, you can yield more into it because you're giving customers more of what they want without those pain points. And specifically on the development side, we're doing a number of things, but we're piloting relicensing and openings, right? 2 processes that are fairly repeatable, data-driven. How do you get folks from chasing all the data around and making decisions and just streamlining the process? Everyone's happier from that, owners, the team, and the like. So I think it's a net positive for all of us.
So we have just a minute left, and I know you guys represent some of the greatest companies that people in this room would want to work for. Tell us one thing that you're looking for now today in someone that applies for a job at your company, and we'll just go down the line, starting with Scott.
I mean, I think the biggest thing we look for is just absolute level of interest, enthusiasm, openness, I think today, to try new things, and to accept that it's not always going to work out the right way, but just persevere, stay calm through that, and just continue to fight for what you believe in, and just continue to be a good person.
Great. Mitt?
I think just the one word that what Scott said, it's curiosity, and I'll just make one comment. We were talking about this. How many real estate folks do you hire versus in the future people that think like an engineer and can look at data and think about the world in a different way? Curiosity.
Karim?
Not afraid to roll up their sleeves and think outside the box.
Yeah, and look, we're very proud of the fact we're the #1 place to work in the U.S. So, folks that really can embrace the culture of collaboration and winning together, because, who knows what the future may hold, but its ability to, as I said earlier, people serving people, both at the hotel level, which our team members are doing a great job here, but also at the corporate level. How do you collaborate together, and also with owners and partners like yourselves?
Guys, thank you all for being here. Please, guys, join me in thanking our panelists for their insights. That was fantastic. Thank you guys so much.